This is Mastering Your Wealth with David Gagnon, the podcast.
You're planning for retirement, you're planning for that rainy day, and you're being proactive. And Dave, this is where you come in. I mean, you have nearly 40 years of experience, guys. This is somebody who knows the ins and outs of the retirement planning game. And I bring that up because a lot of folks go, oh, I'll do it tomorrow, or I don't need to talk about that, or I'm going to be fine. Or we were talking about this before we went on the air. I asked ChatGPT if I have enough money, and it said yes. That right there is terrifying. You know, first it was robo-advisors, and now we have AI trying to direct people if their retirement's on track. And I just can't believe that that's even happening, David.
Yeah. Well, I mean, there's so much to planning decisions that people need to make, and there's a lot of emotions involved. So if you're working with AI, it's tough to have that emotional connection, what you as a client really is trying to achieve, and manage emotions and have confidence and deal with a lot of different moving parts. It's not just investing and saving. It's how do you integrate all the different financial pieces to your plan, such as Social Security claiming, pensions, debt management, cash flow management, tax planning. And then we always want to have a backup plan to your plan, because things will change, and we want to make sure that you're prepared in the event a spouse dies. There's a lot of things that happen to your money for the survivor. So we always have a strategy that kicks in. So when a spouse dies, the survivor we know is going to be well taken care of, because we have strategies in place, and we have the monies positioned according to what their needs dictate to us as far as what their spending requirements will be. When you also have a healthcare event, it's nice to have a backup strategy for that expensive occurrence if you have to pay for out-of-pocket healthcare, whether it's an aide coming to the home or living in the home or long-term care. That is something that's derailing more retirements than anything else.
Absolutely.
So it's good to get your plan in place, but have guardrails on your money. You have airbags on your money. You have a plan that is already well thought out and ready to kick in when things happen. And a lot of people are reaching out to us because they're worried about where the market is currently. It's at a pretty high value, and people kind of get greedy, and they kind of think I want to hang in there and still participate because it seems like it's going up. But you hear both sides of the table. Some people think we're going to have a big pullback. Some think we'll see some progressions forward still. But the thing that you can do with good investment management is put airbags and guardrails on your money so you don't get beat up when the unexpected happens. People feel that it's going to happen, but they don't have the tools in place to protect themselves when it does happen.
Well, let's talk about this, and stick with me, folks. I'll tell you in just a few moments how you can sit down with David if these are things that are top of mind for you. Obviously, cost of healthcare, that's on the rise. I want to talk in just a few moments about folks that are kind of pulling back on their contributions to their retirement accounts because of the cost of healthcare. But I want to focus on this market right now, because you're right. It has been, rocket high, sky high for 3, now going on 4 years. You're seeing a lot of individual gold and whatever kind of stocks. I mean, they're hitting record peaks as well. And a lot of folks going, wait a minute, this is really, we were kind of biding some time here, but now we are really skating on some thin ice of when this is going to take a turn. And when it does, is it going to be quick? Is it going to be slow? A lot of folks worried about politically what's going on in the world, in our own country here. Are these decisions and outcomes going to influence our economy and our market? So there's a lot of different moving things that are happening right now that obviously we have absolutely no control over. So back to your point here, no matter when or what the market does, no one has a crystal ball. It's important to have these airbags around your financial plan. Tell me more about these airbags. What is it? How can you help me with it?
For instance, we always talk about doing on a complimentary basis a detailed investment portfolio analysis for folks. And what's nice about that report, it gives them better clarity as to how their current investment plan is exposed to any type of risk, what kind of returns you might have received, the volatility factors, and then from our conversations determine if those investments are truly aligned with the client's short-term and long-term financial planning objectives. But here's the thing. If we can show them a different way of managing their investment portfolios to take care of their investments with alternative investments and strategic, proactive, tactical money management and the right investment product tools, we can show how you can reduce your risk in many cases substantially and increase your returns that are more consistent. And the analysis I just did last week, we showed the couple on how they can reduce their risk by 55% and increased their yields by almost 40%. That makes a huge impact on what their financial results would look like for many years into retirement, because they have low volatility, low risk, better performance, more yield, more income, more cash flow. So they have more spendable dollars, or they can reinvest and accumulate more wealth in a more efficient, less risky path forward. It's an educational process that we go through because we provide details in their numbers. They get better clarity. Now we can see the problems that might lie ahead or they might be involved in as far as things that are happening in their blind spot. Maybe they're losing money unnecessarily, and how they're managing their money, how they're paying their taxes, how they're managing their debts. All kinds of things could be costing you money. You don't even see it until we point out the alternative ways to make it work more efficiently. But it's what you don't know that hurts you more than what you do know. And so with knowledge and education that we can provide from our perspective, from the stuff we've been doing for decades, we can show folks on how to do things differently, think outside the box, and get better results and outcomes as a result of doing things differently. Because people get caught in a rut. They do things in their comfort zone, and their comfort zone might be very narrow in what they're comfortable in doing, which means they're losing out on broader opportunities because they don't know they even exist or what the tools or the strategies might be. I just think it's always worthwhile to work off of somebody else's experiences and expertise in anything, whether it's in the world of finance or any other endeavor you have, because the people that are out there as experts that have been doing the same thing over and over again for many years have learned and benefited from what they've witnessed and experienced and working within the things that have been poorly affecting people and things that have been successes. So we feed off of all that history of experience to help people going forward into the future. So I just think it's always a great thing that people find a good comprehensive planner who's independent and can look out for their best interest and quantify all their data, evaluate what's working, identify what isn't working, and then implement the right tools and strategies to fix the problems. And that's what we do.
And the great detail you go into, just to kind of, give a glimpse behind the curtain here, folks. I mean, I can't tell you, Dave, you probably spend almost up to 10 hours sometimes on people's comprehensive planning and portfolio analysis.
Yeah, many cases more hours than that.
Yeah, this is in depth. This isn't just kind of like, oh, let me look around and make you a quick little one-sheeter. This is what I think we're looking at. No. This is down to the detail, dotting the I's, crossing the T's. And that's why we only have about 5 slots available, because it takes, Dave, between, 10 to 12 hours to put these things together, folks. And it's complimentary to you listening. If you'd like to come in for this comprehensive planning and portfolio analysis, be one of the first 5 callers right now. That's 203-872-0009. That's 203-872-0009. Get more details on the website at masteringyourwealthradio.com.
I'll just say one thing, Jessica. I was working with a young man a couple of weeks ago, and he was reluctant to give us a call because he likes to manage his own investments, but he figured it doesn't hurt to get a second opinion. And we did that portfolio analysis for him, and what we were able to disclose and in all the details was that he was taking a tremendous amount of risk, and his risk factor was about 70%, and his returns were pretty good for the last couple of years. But when we modeled it out, because you really want to see how your investment plan and your strategy and how you're allocated, how does it work in a full market cycle? Because everybody's going to do well when the market's up, but how does that really get impacted when the markets are in a bad cycle and losing money? And so we always want to look at a time frame from a bottom of a market to the top. And when we went through that detail and we went through the longer term cycle of what a market could do to investment plan, he was in a really vulnerable position if the market does start taking a correction. And that's why his volatility factor was so high at 70%. It's fine when it's up, but when that market starts coming down, he'll see a dramatic drop in his portfolio in a very short period of time. So when we showed him how the important thing to focus on is reducing volatility and risk and having consistency in returns, we're not trying to swing for the fences and hit the home runs, because if you look at that statistic in baseball, the home run teams don't win the championship as often as the teams that have a higher batting percentage that get more hits consistently. Same thing with your money. So if we can build a plan, first of all, it has to be aligned with your goals, both short-term and long-term, but build a plan that's consistently low volatile as far as risk and volatility and has competitive but consistent returns. You're going to have more wealth over time than the one that you've been designing that's there to hit the home runs and get beat up when the market's not doing so well, because it takes time and energy to recover from those big dips. If we look back to 2008, many people didn't get back to break even until 4 to 6 years later after that drop. And so if that happens to you when you're close to retirement or in retirement, that could derail a retirement very easily. And that's something that folks need to avoid. And with good planning, good investment management, that can certainly be accomplished.
And it can certainly be accomplished with his comprehensive planning and portfolio analysis. Again, complimentary only to the first 5 callers, 203-872-0009. That website, masteringyourwealthradio.com. You know, Dave, when things get expensive and money gets tight, let's face it, you got to make some hard decisions. And a new study by Allianz says that 51% of Americans have either stopped or reduced their retirement savings in the last 6 months. And almost 60% say that money is going towards health care. And a surprising 68% say that even if the stock market hits record highs this year, it's not going to help their financial health. So if a client tells you that they're thinking about dipping into their retirement accounts to cover any type of expenses, what are your thoughts on that?
Well, this is one of the hardest conversations people are having right now, and it's happening quite frequently in some of the folks that I'm speaking with. And the first thing that I tell somebody is that you're not failing. You're responding to real world pressure. We have higher healthcare costs, higher debt, higher everyday expenses, and that's different than being reckless with your money. And so when we slow things down, because people have rated their retirement accounts, I've seen that over the years, it's not typically a good decision, because now you're going to pay tax twice on that money, and this is what happens. So you put the money in, and it's growing tax deferred. You borrow it out. Now you got to pay that loan back on the plan, let's say the 401k, because we're talking about a loan from a 401k. You have to pay that back with after-tax dollars. And then you get taxed on it when you take those dollars back out when you retire.
Taxed twice, and yeah, you pay yourself back, but are you really?
Just last month, I sat down with a couple. They were in their early 60s, and the wife had a medical issue last year that drove up their out-of-pocket health care cost, and they were thinking about pulling $40,000 out of their IRA to kind of reset things financially. And on the surface, it sounds reasonable, but once we walked through what the $40,000 net after-tax withdrawal was really going to cost them, it was going to be about $52,000 between the increase they're going to see that they're going to have to pay to cover their federal and state taxes. And so instead of taking that money out, we looked at options, and such as what we did was we restructured their short-term expenses. We freed up some opportunities for some cash there. We looked at, they had some taxable investments or after-tax investments. So instead of using their tax-deferred retirement accounts, we were able to pull some resources from that resource as well. And then we restructured and repositioned some debt and cut down on some of the cost. But they were able to set up a small repayment plan and not need all $40,000 to pay off that debt. So with some negotiating with the healthcare provider and some restructuring of their finances, we were able to find a way so they didn't have to pull out their $40,000 from a retirement account that would have cost them $12,000 just in taxes. And so, in their case, a small portfolio adjustment and a cash flow bridge gave them some breathing room without really permanently, damaging the retirement plan that was there to help them out for many years. And so the goal isn't just surviving the next 6 months, it's protecting the next 25 years. And so a lot of times we can look at the big picture and come up with a better financial solution than rating your retirement account.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com. Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.
David Gagnon and First Financial Planners are not affiliated with nor endorsed by the Social Security Administration or any other government agency.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure of the ADV 2A Item 4 for additional information.